Um, Welcome to today's deep dive. You usually picture a safe haven asset as like a concrete bunker, right? You go inside, lock the heavy steel door, and just completely ignore the storm outside.
Right, exactly.
But lately, holding digital assets feels less like sitting in a bunker and more like watching a hypersensitive wind meter. I mean, it catches every single micro shift in global liquidity. And today, our mission is to deconstruct that intense 24-hour market repricing we saw between May 7th and May 8th, 2026.
Yeah, that was really the ultimate stress test. The market endured this slow, methodical distribution from just over $81,180 down to roughly $79,200.
Wiping out, what, $353 million in leverage?
Exactly. And it wasn't a flash crash. It was a fundamental repricing of global liquidity. To figure out why the bottom fell out, you have to look at the geopolitical failure in the Middle East.
Right, the collapse of that 14-point U.S.-Iran diplomatic memorandum.
Yeah. When that framework collapsed into direct naval combat in the Strait of Hormuz, the economic shockwaves hit immediately. I mean, Brent Crude oil shot way past $100 a barrel. And when energy prices spike that violently, supply-side inflation becomes incredibly sticky.
And then you pair that energy shock with the U.S. labor market data, right? Because April added a very resilient 115,000 jobs.
Which completely boxes central banks into a corner. The math just prohibits the Federal Reserve from executing their planned rate cuts.
So the prospect of fresh fiat liquidity flooding the system just evaporated.
Yeah, and that's why the bunker analogy fails here. Without the promise of rate cuts, the speculative fuel burned off instantly. Instead of acting as a hedge against geopolitical chaos, the asset functioned purely as a barometer for central bank liquidity.
Right, so when that macro liquidity dries up, institutional money just runs for the exits. We saw U.S. spot ETFs bleed $268.5 million in a single day.
Breaking a solid 5-day inflow streak.
Yeah, but if that's how Wall Street paper reacts, what happens to the underlying corporations actually holding this on their balance sheets?
Well, it creates a fascinating distortion, particularly when you look at a company like Block Inc. Operationally, they had a monster first quarter. Gross profits were nearing $2.91 billion.
Right, but on paper, they were forced to report a massive GAAP loss, like $308.7 million.
Exactly, and that's the GAAP remeasurement trap. Because the spot price of their holdings dipped during that specific quarter, regulations forced them to mark the asset down to its current market value. It was a $172.8 million paper loss.
Which is basically an optical illusion. I mean, they didn't sell the asset, they didn't lose any actual cash.
No, but to an algorithmic trading bot scanning earnings reports, Block looks wildly unprofitable. Fundamental analysts have to manually strip out that non-cash impairment charge just to see the true strength of the underlying business.
You really have to wonder if that trap is systematically obscuring corporate cash flow strength. Like, how many other treasuries are delaying their own adoption just to avoid spooking the algorithms?
Oh, absolutely. And while the accountants fight over balance sheets, the physical infrastructure securing the network is undergoing a massive, permanent shift of its own.
Right, the thermodynamic pivot.
Yeah.
Tier 1 miners like Core Scientific and Hut 8 are abandoning pure-play cryptographic hashing.
Because of severe margin compression, yeah.
Yeah.
They are actively liquidating their treasuries to repurpose gigawatts of baseload power.
For enterprise AI data center contracts, right?
Yeah.
These are multi-billion-dollar deals.
Exactly. The economics are brutally simple right now. Their power purchase agreements generate exponentially higher returns hosting AI models than they do running SHA 256 algorithms.
Hold on, though. I need to push back on this. If the biggest industrial miners permanently unplug their rigs to run AI, network hash rate stagnates, doesn't that fundamentally threaten the long-term security budget of the protocol?
Well, it's an aggressive real-time stress test for sure.
Yeah.
But it actually just accelerates a transition that was always built into the code.
Relying on user transaction fees instead.
Right. As block subsidies shrink and industrial players pivot out, network security is forced to rely on those fees rather than a constantly expanding wall of sheer computational power.
So despite all this short-term turbulence, the macro shocks, the GAAP traps, the AI pivot institutional conviction is somehow hardening. I mean, JP Morgan recently declared that the asset has overtaken gold in the debasement trade.
The structural maturation is undeniable. It's behaving exactly as an institutional-grade collateral should under these specific conditions.
Which leaves you with an incredibly provocative paradox to chew on. We are watching dormant whales dump $750 million in legacy supply. We have legacy miners abandoning hashing for AI.
Yeah.
And Wall Street is actively commoditizing access through regulated products like the new Canto Network ETF.
Ugh.
Are we watching the final, painful elimination of retail influence entirely in favor of total institutional capture?
It's a huge question.
Let that sit with you and explore it on your own. Until next time, thanks for joining the deep dive.